Hello, my name is Clive Cochrane and welcome to my YouTube channel. If you are a first-time visitor, then welcome, and can I suggest that you decide to subscribe to this channel. That way you'll be notified as to when I release new video material, which I do on a regular basis. And if you are returning, then welcome back. What I want to cover in this video has to do with what is known as the yen carry trade. And I'm going to talk about the particular circumstances of the Japanese yen, which is attracting a lot of attention in the foreign exchange market and indeed the wider capital markets. And I'm also going to tie it in with a little bit of history even to do with what is known as the yen carry trade. To begin this discussion, let's focus initially on a simple dollar-yen relationship, where we are not really focused on the yen carry trade per se, but just looking at the specific relationship between the dollar and the yen. Now, on this particular day, which I've captured here in late January of 2026, you can see a daily chart for dollar yen extending back to exactly 1 year. Now, over here where we are today, on this particular day, you can see that the relationship or the exchange rate dollar yen is around 154. At one point intraday came to 153. But what I want to draw attention to here is that during the last few trading days, this exchange rate had moved very close to this level here of 160. And this is known to be, in fact, a little bit above a level that the Central Bank of Japan, the BOJ, is keen to defend. In fact, if we go back here, almost exactly 1 year to early in 2025, you can see a similar phenomenon that the dollar yen reached up towards this 159, 160 level. At this point, the BOJ, the central bank in Japan, decided to intervene in the FX market, and essentially what they do is buy yen by selling dollars, which has the effect of obviously strengthening their own currency, the yen, against the dollar. And as can be seen, this turned out to be successful in the sense that they managed to bring over most of 2025 the dollar yen back down towards a level closer to 140 than the high 150s, 160 level over here. So at the present time, this particular chart action is attracting quite a lot of attention in the foreign exchange markets, drawing attention to a number of things that are quite significant about what's happening in the Japanese financial economy, one of which relates to very high yields, historically high yields in fact, on long-term Japanese government bonds. Their 30 and 40-year yields have reached levels not previously seen, and one of the effects of this is that the Treasury in Japan, the government, will no longer be issuing, or certainly very little issuance of long-term government bonds. This is also related to what many perceive to be very high, unsustainable perhaps, levels of Japanese government debt to their GDP, the highest in the developed economies. Okay, so with that in mind, what I want to do next is turn to a more specific discussion about the carry trade. So what I have now is a chart showing, a daily chart showing Mexican peso against the yen. It's for the same day that we discussed just a moment ago, the January 26th date. And as can be seen here, this only goes back a shorter period, only 2-3 months. But what I want to focus on is the activity on the chart over here. So during the period we saw on the last chart, which was to do with dollar yen, and that issue to do with the BOJ wanting to defend the level around 160, you can also see that the Mexican peso during this period, in January essentially, has weakened considerably against the Japanese yen. Now, essentially what is going on here, which is a way of bringing the discussion about the yen carry trade into focus, is that The yen is very often and has been very often used as the funding currency for the forex carry trade. So let me explain what I mean by that. If you are, say, a large trading firm, a hedge fund, even investment bank, and you want to engage in the FX carry trade, you would be able to borrow Japanese yen at very reduced rates on a comparative basis. So you could borrow large amounts of yen at the optimal short-term rates. You could then convert that currency, the yen, into another currency, in this case, let's say the Mexican peso, because you could exploit what is known as the carry. Carry is one of those terms widely used in banking, which, let's say we take out the foreign exchange overlay idea. If a bank can, say, borrow from its central bank or borrow in the money markets at a relatively low rate, let's say X%, and then can lend to customers via loans and credit cards, etc., at a much higher rate, X plus 5, X plus 10% perhaps, they can earn carry. Now, the idea with the carry trade in the world of foreign exchange is that you do essentially that, but you introduce two currencies. So in the particular example on the screen, what you're seeing effectively is people that have borrowed yen, gone short yen, then converted that currency, the yen, let's say, to the Mexican peso, and they have been able to earn the carry, the difference between the rate they're borrowing at and the rate they can earn with, let's say, maybe Mexican short-term government bonds and so on. But of course, you then bring into this particular trade the risk of a significant move in the exchange rates. So just to summarize what I've said, the forex carry trade can be seen as a standalone strategy or part of an integrated macro strategy practiced by, say, hedge funds, quant funds, or investment banks. The idea, as I've said, is you sell, go short, effectively borrow in a low yielding currency, such as the Japanese yen. Historically, that has tended to be the funding currency. You can also use the Swiss franc. Once you have this currency, you convert it into another currency where you go long and lend essentially this new currency, the target currency, and you invest it, let's say, in short-term government bonds. So, for example, you might have converted your yen into Australian or New Zealand dollars or Mexican pesos and then invest in the short-term government bond market for those countries. The motivation, therefore, is to exploit the interest rate differential. But of course, you then take on the risk that there could be a substantial change to your disadvantage in the exchange rate. So if the funding currency, in this case the yen, dramatically increases in strength against the currency that you've converted it into, let's say Australian dollars, New Zealand dollars, or Mexican pesos, that can wipe out and more the actual benefit of the carry. And in fact, this is exactly what happened many years ago in 2007, and I'm using a chart here from this period. You can see here, this is the period starting in 2007. So of course this is 1 year prior to the financial crisis, but what we're actually seeing here is perhaps some of the early tremors in what ultimately unfolded in the second half of 2008. So let me just explain. This is the New Zealand dollar, sometimes called the Kiwi in the FX world, against the Japanese yen. Starting back here in, say, March of 2007, you can see a steady upward trend of the Kiwi strengthening against the yen as more and more funds and speculators were engaging in the carry trade. They were borrowing yen, converting into New Zealand dollars, and then, say, buying 2-year New Zealand government notes. So the Kiwi strengthened all the way to this level here, close to 98, at the end of July of 07. Now, what happened after that in the next less than 3 weeks is quite remarkable. The Kiwi collapsed essentially against the yen, dropping more than 25%, all the way down to the level on the screen. You can see 74. Now, the only way this can be explained is because there would have been no dramatic change in the economic fundamentals between New Zealand and, say, Japan, is that what was going on was a dramatic unwind in the FX carry trade. What was happening was that because some of the large players in the carry trade, including Goldman Sachs, as you'll see on the next slide, and various other hedge funds, began to get concerns about things that were happening, say, in the New York money market, the beginnings of the subprime crisis and so on. There was a mad rush for the exits to exit this quite risky trade. And once the momentum began, as people started basically selling New Zealand dollars, buying back the yen that they borrowed, as you can see, this led to essentially an avalanche of selling, bringing us down by, as I say, more than 25%. So just to summarize, there were huge losses in this period, August 07, some, for example, incurred by one of Goldman Sachs' internal funds. In August 07, as the subprime mortgage crisis began to freeze credit markets, the repo market in New York and so on, these speculators, including hedge funds and Goldman and so on, decided to exit in a hurry their leveraged risk-on carry trades. This triggered a massive spike in the yen as traders rushed to close their short positions in the yen, which they'd been using to fund their long positions in both, say, the Australian and New Zealand dollar. Goldman's Global Alpha Fund lost around 22% in August 2007 alone. And the company has acknowledged that a large portion of this was attributed specifically to the Australian dollar and the New Zealand dollar falling sharply against the Japanese yen. So as you can see, understanding a little bit about the history of this particular trade, the FX carry trade, can be quite useful in understanding some of the rather dramatic, momentous moves in not only FX, but in other parts of the capital markets. And they may have some bearing on some of the things that are happening at the time this is being recorded in January of 2026. Well, I hope very much that you found that discussion to be interesting and useful. And could I then recommend that you subscribe to my YouTube channel, the Corcoran Codex. There is no obligation per se, but you will then be notified as to when I release new videos around the theme of analyzing critical ideas and episodes in the world of global finance. Thanks for watching.